Hey, good afternoon, James. Thank you so much for being here with us today and taking some time out of your busy schedule to meet with us. With me, I have my colleague Devin, and we're going to talk about the future of your company and future of your investment, or future of your career in ERP. So just get started here. Just show you a brief outline of what we're going to do today. So just context of what's going on right now with Palisade, and first off, a little bit different, we have a recommendation up front just so you know where we're going with this, and then following is going to be how we got there. So our analysis of the environment, your company, the valuations, and kind of risks implementation. Okay? So first off, context, you guys have an offer right now from Leaside Capital for $10 million of your company. With this, you will be continuing to manage the company, and then you'll receive an additional 20% payout of the company after the 5 years is up. Okay, so today we're here to value Palisade and assess the offer at hand. After that, we just want to talk about some of the future plans for Palisade and just discuss some of the best options for the company. Okay, so our recommendation is that you accept this offer for negotiations. Okay, so we think that this is a little bit low end, and that you can look to sell the company for a little bit higher, to 13 to 15. You're still going to be a part of the company managing, so you can still help grow it because it is your baby. We understand that you have built this up right from the ground. So it shows that we want this offer. Your company's worth a bit more than what they have right now, and we just want to make sure that the arrangement lets you pursue the opportunities in the ERP installation opportunity, as well as the software as a service investment project. So, first of all, the ERP software industry. It's kind of been dominated by Oracle and SAP for many years, and since 2000 there's been some new innovation where new firms have been targeting small to mid-sized businesses, and this is what your companies are focusing on. So the problem with this industry is that it's very, very technical. So there's technology that is forever changing, and you have to be very innovative and stay ahead of your competitors, right? So right now, or in 2009 there was a recession, and many companies were affected, and a lot of ERP software companies took hits, but your company was much better off just starting out and succeeded past the recession and did very, very well, reaching double, triple profit, or revenue growth. Okay, so another thing to consider is that there's growing competition in this industry. So specifically in the small to medium-sized businesses that you're targeting, there's a lot more competition toward these. Okay, so Palisade, their competitive advantage is that you've created a new market, right? So you're targeting the small and mid-sized businesses. You're doing this not by having a huge implementation of the ERP system, but rather you're doing it as a monthly process, or a monthly payment fee, and it's very simple to install. It doesn't depend on the client's current systems. So right now you're doing very well, some really strong growth, but you need to keep innovating. There's increased competition, specifically in your area, and you need to pursue the new opportunities that you're facing. The problem with this is you've already invested so much of your finances, your personal finances, into building this business, and you need to consider other alternatives to investments to build up your company. So just to conclude on qualitative stuff, this is a very rapidly changing industry, and you have to be innovative and stay ahead of all the competitors. As well, you need to find financing so you can pursue these new projects that are going to help you stay ahead of your competitors. And right now, you have to be realistic about where you're going to get these investments. You have used your entire life savings up on starting this company and building it up. You can't stretch anymore. You can't take from your own mortgage a line of credit. It's not realistic. It's a high-risk industry, and you need to find some other way to finance these projects. Now I'm just going to pass it off to Devin, who's going to do the discount cash flows.
Thanks, Rachel. So we looked at 3 different valuation methods for you today. One was a discounted cash flow, one was the precedent transactions analysis, comparables analysis. So firstly, we're going to look at the discounted cash flow analysis. So what's going to go to discounted cash flow analysis is that it gives you the intrinsic value of the company. If we have all of our assumptions correct, it will give you a perfect value of what the company is actually worth. However, a downfall of this is that every input needs to be correct in order for this to be the case. So let's take a look at some of the assumptions that we use when creating our DCF. First of all, we assume that when in our depreciation calculation, that it was equal to the CCA tax shield. For our cost of equity, which we got at 52%, we used the risk-free rate of 2.91%. We used the beta of 1.5, which was the beta you had provided. And we used the market risk premium of 33%, which was provided by Eastside Capital. We felt that that was the best market risk premium to use in our calculation. And we felt that the beta of 1.5 was a better beta to use than the industry beta because of how leveraged the company was. It was a small company and it has a little more risk than the industry does. Looking at the cost of debt, we calculated that at 5%. That was based on what you thought you could take on more debt for. Looking at the weight of debt and weight of equity, it was 62% and 37% respectively. The tax rate at 30% was what you expected over the next 5-year time period. And that arrived at our weighted average cost of capital of 21.74%. So let's take a look at how we got the calculations of our cash flows here. So we took a look at first, the first free cash flow is just of the SaaS system. And we took a look at the net income, depreciation, and amortization we forecasted throughout the time period. We forecast the capital expenditures and change in our capital were given for us. And we've arrived at the cash flows for the SaaS along the bottom there. For the change with the installation, this was including the ERP installation as well. So we had to include the extra capital expenditures, extra change in our capital, and the change amortization and depreciation associated with that as well to arrive at our free cash flows for both. So you can see that in the first 2 years, it does decrease slightly. However, it receives better cash flows at the end of the time period. So let's take a look at our DCF cash flow analysis. Now, there's a lot of numbers here. What's important for us is to just take note of what is highlighted in blue. That was what our discounted cash, that was what our discount rate we used was, of the 21.74%. So from year 2011 to 2016, we have our cash flows along the left-hand side, and you can see that they're discounted back at the 21.74 discount rate there to give you a present value of our future cash flows at $7.8 million. We included the range here from our 30% to 18%, just in case some of our numbers were slightly off, and it just gives you a little better sensitivity analysis of our recommendation for you. One thing to note is that in our cash flows here, what was required when you were accepting this deal was that in order to be repaid the 20% at the end of the 5-year time period, you need to have $3.5 million in net income for that year. So as you can see, in 2016, even just with the SaaS system, you are receiving $4.2 million. Now, taking a look at the terminal value, we used a 2.5% value for the terminal value. Now, we felt that the 4% we provided was a little high. The terminal value of the company we chose of 2.5% would be around what we would expect the GDP to grow at, plus a little bit extra. So, taking a look at that, we got a present value of the terminal value as well, leaving our enterprise value at around $16 million. This was keeping in mind that if we did not take on the installation, the ERP installation, as well as the SaaS system. So moving on, this valuation here is including both the SaaS and the ERP system. So as you can see, the cash flows are slightly lower in the first 2 years. However, by year 5, the cash flows are greater, and this gives a better value for the firm. Taking a look again at the $6.3 million we are receiving in year 5, that is much better than not using the ERP system, as it gives more positive cash flow, and it's better for the terms in our view to receive $3.5 million in year 5. Also here, just important to note that we did include the range here from $13 million to $24 million when we were doing our final calculation for you based on our three valuation methods. So with that, I'm just going to pass on to Luke, who's going to get into the precedent transaction and comparable analysis for you.
Thanks, David. So before we get into precedent transactions, I just want to give you an idea of what it is, kind of why we chose to include this in our valuation for your company. So basically what it is just gives you an idea of what companies are being bought for within the same industry, and they're all within a relatively similar time period, so it is a fairly good representation of what people might be willing to pay. One thing to note here is generally the multiples that we derive will be a little bit higher based on the fact that there is a control premium built in. So some advantages here. It is fairly current, as I mentioned, so it's not going to be outdated. It's not going to buy something that isn't really comparable for you. The disadvantages are there will be implications with the transactions, things that we really can't come across through public information. There's information we don't have as the specifics of the transaction, so it can imply some implicit premiums or discounts that we really can't include in the application here. So, moving on. The companies that we excluded here were Sheraton and Marcel. The reason was the focus for Sheraton was a little bit inconsistent. They focused more on the smaller end, and then the size of Marcelo, it was significantly larger, so this wouldn't really provide a value of comparison for it. So getting into the numbers here, what we've derived is the price to sales multiple as well as the equity value to EBITDA. And basically we've taken an average of the 3 remaining companies in the set and multiplied it out by your sales to EBITDA for 2011 to come to a final equity value based on the average of the 2 of around $8 million. So one thing to note here is that is a little bit lower. We just want you to keep that in mind moving forward with the on the table. So for the trading comparables, advantages here are this is up-to-date information. This is what companies are trading for within the market right now. The disadvantages, the entire market as a whole could be overvalued, could be undervalued, which will be kind of implicit within the numbers, and it's something you can dig out with the external analysis that we provided for you. So the companies that were that were excluded here were SAP, Sage, and Infor. The reason for that was just because we didn't want to bundle up the valuation here with different currencies, and then Infor, it was a private company. So we just wanted to keep this as simple and digestible as possible for you to take note of it. So as you can see here, we've done essentially the same calculation as in the rest of the transactions. The only difference here is that we've used an equity value to EBIT and price to sales. Another thing to note here is that this is all 2010 data, so this is slightly outdated. It's from last year. We have had significant growth since then. Moving forward to the next slide here. The final value that we come up with was about $9 million, so it is safe to assume that the value of the company today will be slightly higher than that. So, just to make this kind of easy for you to follow, what we've got up here is essentially a liquidation value for your company, and we've just thrown that up there as a, just to give you an idea of how much it's grown, and it's really based on the service that you provide rather than the assets that you have in the company. In addition to that, we've got this kind of cash flow, precedent transactions, and trade comparables all up there. And we provided a range here, that's the blue vertical bar there, about $13 to $15 million. This is where all the transactions, or the valuations kind of overlap. So in order to take out some subjectivity associated with just applying an arbitrary weighting to each, we chose that, and we feel that is a more accurate representation of the company. So the recommendation, as we've already told you, is to accept the offer, but pending further negotiations. We do feel that it's a little bit low based on the valuation that we've provided. One thing that we do want you to keep in mind here is just based on where you are in your career, we don't want you to view this as a sale of a company that you really watch grow and succeed. We don't really want you to view this as a loss. We want you to view it as a transfer of risk, because that's really what you're doing. You're still going to have the opportunity to manage the company for the next 5 years, continue to watch it grow, and you're really not losing what you put so much time and effort into. So with that, again, our recommendation is to go into the negotiations and just ensure that venture capitalists are on board with where you see your company going in the next few years, and that they are going to make those investments that you do need in order to continue to expand and grow, which we don't really see as an issue just because obviously they're in it for returns, and that is how you're going to get the most value from your company moving forward. So, just to go over kind of the assessment and the implementation and what you should be going forward, I just want to pass it back over to Kevin, and we'll wrap up the presentation.
Thanks, Luke. So, when we were setting this offer today, we need to look at some criteria in order for us to make sure that this was the best option for you. So we took a look at several different factors here. We took a look at the value you received, the rationale for you accepting this bid, the timing, whether this was a good time for you to pursue this bid, and the impact it's going to have on both you and your company going forward. So first of all, let's look at the value. So you'll be receiving 13 to 15 million based on your $500,000 initial investment. Now, this is a very key investment, and again, based on the value of your company, we believe that the $13 to $15 million value is good. Along with that, you still will be continuing to be part of the company, facilitating its growth, and be getting that 20% return back in 5 years, contingent on you maintaining the $40 million in sales and the $3.5 million in net income, which both, based on you investing in the SaaS and ERP system, would be both easily viable. So taking a look at rationale. Now, what is good about this bid is that, again, as we mentioned earlier, it's a very high personal risk to yourself. The other financing options you had were caused you to take on a mortgage on properties you already had, and that's just along with all the money you've already put into this business. It would be a good opportunity for you to see some positive return, as well as continue to see it flourish going forward. As well, we do need financing to grow the company. Financing that we do need would be to take on these current projects in order to stay competitive in this environment. So the rationale here really hits both of these points, as we do need the financing, and getting this financing will help our company in the long run. Timing here. So is this the best timing for us to take on this bid? We believe it is the best time for you to take on this bid, because now is the time we do need the financing to stay ahead of competitors that are entering the market. We can see from the revenue projections that the revenue is expected to drop off from where you expect it to be. Next year, you expected it to grow at 20%, and following that, you expected 40%. We feel that, again, that may be slightly high. So to stay ahead of the competitors now, it's a perfect time for you to get the necessary capital you require in order to take on these projects. Finally, the impact here. This will allow Palisade to grow and develop within the industry ahead of the competition. Again, just as we mentioned, it all kind of links together here, that you do need this additional financing in order to grow your company. And finally, the venture capitalists are here solely for the return on the company, and they're going to be your source of financing. So just ensuring that you maintain a positive relationship with them going forward would be beneficial for you as well. It would be good for you just to ensure that you maintain both the $40 million in sales and the $3.5 million in net income in the 5-year time period to receive the equity of the company that you deserve for putting all the time in. So moving on here, we have some implementation ideas for you, just a little bit within the next few days, and then a few points within the next 5 years as well. So first of all, in the next few days, we want you to go ahead and negotiate with Leaside for the increased sale price. So again, we're looking here between the $13 to $15 million range. We feel that you can get that as the $10 million range. It's just the first offer bid. And because they feel that they will drop their bid if you do not accept it, we feel that there is some genuine interest there and that they will be able to increase their price. Secondly here, we have to make sure that it's contingent on the future investment in both of these projects. We do need these projects going forward to maintain competitive in the environment and to grow our net income as well going forward. So it would be beneficial for both parties if we were to invest in both of these opportunities. Finally, within the next 5 years here, we just want to make sure that the relationship with the investors is strong, with Leaside Capital, to make sure that you are maintaining a good assessment of how the company is doing, and making sure you're taking into account all the risks of the company as well. Finally, we just want to do some internal checks on the revenue and the net income to ensure that our projections going forward are adequate, and that we're all still on the same page going forward, along with the investors and ourselves. So moving on here, these are just some risks and mitigations for you here. One possible risk is that Leaside will not negotiate a higher share price. We feel the probability of that is low, based on it being their first bid and them willing to take the bid off the market at the table if we do not accept it. So a mitigation for that would be to go to the open market and look for bids. Clearly there's some interest in this company. We've shown a very positive year last year. So it may be a smart idea to go to the open market as well. Finally here, we may find some integration risk as well. Moving over from it being run by our company in order to be run by a share between us and the venture capitalists. So some mitigation here is just to make sure we have clearly defined terms in our initial negotiations. And so with that, I'm just going to leave our summary slide up for you, and open the floor to any questions.
normally goes first, so.
Yeah, we're all looking at Usually always present Mike.
Sorry, in your comment, I think was Dale was saying that there was a suggestion that the projections were overly optimistic. So therefore, I'm concerned about whether or not there's a probability or what analysis you've done on whether or not I'm going to get the 20% sweetener at the end.
Okay, well, when we did look at the valuation between on the DCF and just looking at the net income projections, based on what the projections were, you still would be receiving the $3.5 million. It was around 6.2, I believe. So that you'd be receiving the $3.5 million in the fourth year, based on you going into both of these projects. So even if the revenue levels were to decrease, not throughout the same rate that they were before, they would have to drastically decrease in order for you not to achieve that $3.5 million net.
But the sales are 10 times what we're talking about today. Is that probable?
Based on your projections, the sales were still above the $40 million mark, and we do feel that we would be able to achieve that. Based on if we were to implement something such as allowing businesses to purchase more than 20 of our licenses, perhaps, if we were to input that, it could probably do a lot to increase our sales going forward.
So on one hand, you're making the suggestion that you're telling them to accept the bid on contingency that you're going to counter offer. You're not really accepting the bid, you're going back to the counter offer.
Correct.
Your valuation, you're saying that, 8.78 million is the fair valuation. You're offering a premium of 10%. How do you come back and justify a premium almost 30% above what the valuation is?
I think some of that has to do with just current market conditions. We've seen a lot of growth in the last couple of years coming out of the recession, but still not kind of where we see it going. Based on some of the projections that you have for us in just the growing market in different segments, it is likely that it's going to stagnate, but it is growth is staying fairly high. So, in our opinion, the value should still be slightly lower based on the market value. The inherent value of the company is significantly higher. And going forward, I think there's a lot more potential than what they kind of priced in there.
So I'll ask in a different way. I'll offer you $10 million and they're coming back and saying they want 13.
Yep.
How are you going to convince me that you're putting forward?
Okay, so first of all, Lisa came in and said, this is an offer, you can't go to anyone else. So there's going to be a lot more room to negotiate with that price, based solely on a relationship built with them. So if you need our help, we're more than willing to go with you and help with the negotiations. Your value inherently is worth more than $10 million, and there's no way that they would just drop this offer and say that, no, we're not going to negotiate $3 million, when revenues are going to be over $40 million in 5 years.
I just wanted to add to that, if you do look at the graph that we provided for you based on the valuations, the discounted cash flow that includes the comparables, the values that we've kind of come to there. It's on the lower end of the DCF. That's basically the fundamental value of the company, and it's right in the mid section of the comparables, so it's really not that far off. I think it's kind of drawn back a little bit by the recent transactions, but we do
So what you're saying is basically if you go ahead expectations are met to reach the $40 million target, then today's value should be 13 to 15 minutes.
yes, and there is room for error there. So if the growth doesn't happen quite the same, we still will be higher based on those projections.
But if he's getting $10 million today and has 20% future value, would you take that into account in your analysis and maybe that gets you
I think based on the fact that we are going to be running the company for an additional 5 years, we didn't want to price that in. We do still feel that 20% should be kind of provided on its own, just as sort of a retirement bonus, if you will. So something to part with if things were to choose for 5 years.
That's a good question, Nancy.